Welcome to the InterMarket Analysis video update. This is a video that I do every week, and I look at a number of different areas. I look at the valuation of the S&P 500. I also do a pretty extensive study between growth versus value, and we look at other markets and sectors outside of the S&P 500 and compare them to the S&P 500 to see if we can get some any clues as to what's happening within the stock market itself. This is being prepared for Monday, November 4th. Before I get into the video, there's a thing called the SPXInvesting Program. It's up, it's going, it's free until the end of 2024. If you're interested in that, please feel free to click on the link below this video that will take you to the website or to a video that goes into more of an explanation. If you have any questions, here's an email address where you can contact me. Also, the video that you're watching right now is the intermarket analysis video, but I do a number of weekly videos. However, everything ties into the daily video, and that's where I do the most analysis and commentary. So feel free to check that out if you find that helpful. Let's first look at S&P 500 valuation. The first chart that we look at looks back at earnings that have already been released and compares them with price. And we do this by using a PE ratio. On the chart, you can see three dashed lines. There's a green dashed line, a blue dashed line, and a red dashed line. And this corresponds to a PE ratio of 10, 15, or 20. We're above the red dashed line, and we've been above the red dashed line for a number of years now. And this suggests that while looking back at earnings, we are considered expensive right now. Also, this shows that same thing, but some different events that have happened going back to 1980 and what the valuations were at that time. Robert Shiller came up with a variation of the PE ratio called the Shiller PE ratio or CAPE, and right now we're coming in at 36.46. To give you some context, here's a historical chart as well as the median and the mean, and we're between 16 and 17. So based on that, a reading of 36 is still considered to be expensive on a historical basis. Another variation is put up by Real Investment Advice, where we look at the growth trend, and that's the dashed line that you see here. And we're above that level now, coming in green. And so even this way of looking at this shows that the market is considered to be expensive historically. But the market uses a forward-looking PE ratio. What's going to happen into the future? The green area, the purple area here, shows what the mega cap 8 forward PE ratio is at 29.7, and that's well above the 20 level. So this is considered to be expensive, but investors don't seem to mind that. These are stocks like Google, Nvidia, Apple, and all these are put together, and they have a very high PE ratio right now, but the hope is that they're going to buy a stock now and have it go up in value to sell it for a profit. The line that I focus on the most is the red line. This is the forward-looking PE ratio for the S&P coming in at 21.5. So still, it's above that 20 level, where we have the the mid caps and the small caps coming in right around the 15 area. So they're more fairly priced. We also look at growth versus value. Here's just a look at growth all by itself, which is in an uptrend, but saw some weakness as we saw the S&P have a little bit of trouble in Thursday session, and then tried to bounce up a little bit on Friday. Here's a look at the value index, also going sideways, but still in an uptrend. Then we do our analysis, comparing growth with value on a ratio basis, and we can see here that growth is outperforming value, and inverse shows you how value is underperforming growth. We also look at this using ETFs, showing how growth is outperforming. Here's an inverse showing how value is underperforming. Then a little bit longer term chart here showing how growth continues to outperform. This shows on a shorter term chart how value is underperforming growth. And we also look at another index look showing how growth continues to outperform. And so that's more positive for the market. Then we look at a growth versus a value ETF, and we had been showing an improvement here coming up out of the rainbow. Well, with Thursday's decline, we went back into the rainbow, and we're kind of at the top end of the rainbow right now, improving. But we wanted to see this continue to go up to be more positive. If it does turn and go back up, that will help the market. If we continue to fall down, that would actually be more negative for the market. This also shows those same ETFs, but inverse, showing how value continues to underperform growth. We look at the small cap growth to value in a downtrend overall, pretty much going sideways at best. Mid cap growth to value also showing some improvement here, but still in a longer term downtrend. What's holding up a little bit better is S&P growth to value, where we're in an uptrend. We did pull back in Thursday's session and we're virtually unchanged on Friday with this ratio. We want this to go up to be more positive. If we go down, that's more negative. One thing that we'll be looking for, if the S&P continues to go down, will this ratio be going up or down? If the ratio is going up while the S&P is going down, that could be more positive, meaning that the smart money is in buying growth even when we are declining. We keep an eye on inflation. This is a monthly chart of the CRB index, which pretty much has gone sideways. We look at a ratio between inflation and deflation, showing how inflation has been underperforming deflation, and the market likes that, at least for right now. Here's a daily chart of the CRB index, and you have the different areas that make up the CRB index here. Been chopping around quite a bit. We started to have a downtrend, then the CRB index started to go up. It's trying to cross back over and give us a golden cross here, but we've been seeing some recent weakness in the CRB index. We look at the Baltic Dry Index as a general rule. When this is going up, that's more inflationary. When this is going down, that's deflationary. We've been chopping sideways, but lately we've been breaking to the downside, which means it's more non-inflationary or deflationary right now. We keep an eye on different markets, even though I'm not actively in these markets. We just want to watch them anyway. With aluminum being in an uptrend, corn is in a downtrend. Wheat has been chopping around, but still in a downtrend. And we keep an eye on fertilizer, where it had been going up, but lately we've seen it coming back down slightly. We're watching oil. We always watch oil, but right now we're watching it mainly for geopolitical reasons due to what's happening in the Middle East. Now, if oil goes up because oil companies are making more money, that's positive for the stock market. But if oil goes up because of geopolitical tensions, that could be negative for the market. We look at a gold to oil ratio. When this is going up, that means gold is outperforming oil. Then we look at the 10-year yield, which is in black, and then the red dashed line, which is oil. We look at the correlation between them. They're not really going in the same direction right now. They're neutral to slightly going in opposite directions. Gas is in a downtrend right now. Heating oil also in a downtrend. Natural gas chopping around here, but trying to get back into an uptrend, but still in a downtrend overall. Copper is also in an uptrend right now. This just suggests that the economy is looking okay going into the future, but this has been really choppy lately. We look at a copper to gold ratio. When this is going down the way it is now, that means that copper is underperforming gold. And gold's coming off of setting a recent all-time high here in an uptrend. Silver also in an overall uptrend. We look at the closing value for gold and silver and then see the correlation. They're actually showing a little bit of a weak correlation right now. Usually they have a pretty strong correlated relationship. We look at a gold to silver ratio on top. When this is going up, gold is outperforming. When this is going down, silver is outperforming. Then we plot that against the US dollar index down below, but we're not really getting much here as the top chart and the middle area of the chart are actually having a tendency to go in opposite directions. Here's a long-term chart of the copper to gold ratio that's in black where it's going down. We also plot the 10-year yield in red and the 2-year yield in green. And over the last decade or so, they've had a tendency to move in the same general direction. For quite a while now, we've been seeing them go in opposite directions. We're seeing interest rates going back up as the copper to gold ratio is going down, as the market is adjusting to a new kind of economic environment. And the dollar has been really strong lately, even though it's still in a downtrend looking at the daily chart. This also shows the breakout that the dollar has seen above this trend line. The euro, which is in an uptrend compared to the dollar, but lately has been seeing some weakness. And here's a breakout chart showing how the euro's been coming down, but we're still in an overall uptrend to the US dollar. The Japanese yen has been in a downtrend. It started to bounce back up. It's also in an uptrend compared to the dollar, but some recent weakness has been coming through. And here's where we see the breakout chart. Here's the uptrend of the yen to the dollar, but weakness coming back down. The British pound also in an uptrend to the dollar, coming down to about the 200-day moving average. We'll see if that area holds, and if this bounces up, and the dollar would then be going back down compared to the British pound. We look at a number of different index ratios, and I show this in the daily videos. So not really seeing anything out of line right now, where we've had some weakness with the S&P. We also have some weakness here with the red line, which is an equal weighted version of the S&P. This is a ratio between the equal weight and the regular S&P 500, just kind of chopping around right now, not seeing any real movement in one direction or the other. We compare stocks with commodities, showing how stocks are outperforming. Here's an inverse, again, to show how commodities are underperforming underperforming stocks. We look at the NASDAQ 100, which is continuing to underperform the S&P 500. Now, they both have done well, but the NASDAQ 100 set its high last summer, where just a little over a week ago, the S&P set its high. And even before that, we saw where the rest of the S&P, which is a broader index, has been outperforming the NASDAQ 100, which on a comparative basis has fewer stocks, hence the name NASDAQ 100. And the S&P 100, the biggest stocks that make up the S&P, are outperforming the rest of the S&P 500. The NASDAQ, which is coming off of a recent all-time high, but the S&P is also coming off of a recent all-time high. So even though we're seeing a little bit of an improvement here, we are in a downtrend with this ratio. The NASDAQ 100 has been underperforming the NASDAQ pretty much going back to early spring, even though the NASDAQ set a high in July. Since that time, and even before that, we were seeing how the NASDAQ 100 was underperforming. We look at the mega caps, the really big companies, and compare them with the equal weight ratio. And when this is going sideways like that, it just means the rest of the market has been holding up a little bit better lately. Small caps, though, continue to underperform the S&P. Here's another look. The red line is the same ratio we just looked at, and we plot the S&P 500 here, and they're having a real tendency to go in opposite directions now. We also look at small caps versus the tech sector, and this has been choppy quite a bit lately. We're trying to see a golden cross here, as tech has been a little bit under pressure, and recently small caps have been doing better, but now we're seeing tech doing a little bit better and small caps underperforming as it tries to work out what direction this ratio will go. The big software companies are seeing an overall uptrend, mega cap growth pulling back, coming down to its 50-day moving average, but still in an uptrend. The robotics and AI ETF is up at the top end and actually coming out of the rainbow and showing a little bit of an improvement here when we do a ratio between the AI ETF and the tech sector. The Dow Jones Composite, which is the Dow, the transports, and the utilities, seeing the Dow coming off of a recent all-time high. Transport's doing a little better, but pretty much going sideways. Utilities have been strong in 2024, but they've been pulling back lately. We're coming down to close to the 50-day moving average with this composite here. The Wilshire also coming down and testing its 50-day moving average. So we're going to be watching a lot of different indexes to see if the 50-day moving average holds. If we break below that, especially with the S&P, that's going to turn the intermediate term trend to negative. We did drop below the 20, so we're negative in the short term, but the intermediate term for right now is holding. The total U.S. stock ETF also coming down just about to its 50-day moving average. Low volatility stocks. These are in an uptrend. Also, they've been pulling back recently here. And the market usually likes these when the market is becoming more defensive. Well, this has been in a solid uptrend, even though we've been going up quite nicely in 2024 with the S&P. When we do a comparison or a ratio here, it shows how the volatility stocks are continuing to underperform. Now, they were starting to bounce back up enough to generate a golden cross with this ratio, but lately I've been seeing some weakness and doing a lot of chopping around. We keep an eye on the advanced decline line with the NYSE common stock for the first time since last summer. We're actually dropping below the moving average here. So a little bit more weakness than what we've seen recently. The S&P is coming down to its moving average, as are the mid caps, and the small caps are already below their moving average here. So a little bit more weakness with the small caps and the broader measure of the NYSE common stock. We'll have to see if the S&P ends up bouncing up off of this moving average or continues to fall down below it. We have traditional Dow theory, which just looks at the Dow on top coming off of a recent all-time high, and then the transports. And they've been showing some improvement here, but I'll show a chart later on that shows how they pretty much have been going sideways. Now, I also include a third element in traditional Dow theory, which are the utilities, and they've been really strong, but pulling back lately. Here are the transports showing how, they're doing okay here, but not really breaking out to the upside and pretty much at the higher end of the range of what we've seen in 2024. We do a ratio between the transports and the S&P. When this is going down, as it pretty much has been lately, that means the transports are underperforming, even though the last couple of trading sessions we've been seeing an improvement. We also do another ratio of the Dow versus the transports. When this is going up, that shows that the Dow is outperforming, even though it's pulled back lately. We look at the correlation between the S&P and the transports, and that's really fallen off now as the S&P has been going down over the last, well, especially on Thursday. That was a big day. Friday, we tried to bounce back up. Transports have been seeing a little bit of strength here, and that's why we're seeing this correlation really dropping off. Then, instead of using traditional Dow theory, we have a new look at Dow theory, where instead of using the Dow, we use the S&P 500 up here, and instead of using the transports, we use the NASDAQ, which is coming off of recently setting a new all-time high. Then to break that down a little bit more, instead of using the weighted version of the S&P 500, we use the equal weight version and compare that to an equal weight version of the QQQs, which is the NASDAQ 100. And seeing a little bit of a negative divergence here, where we're going down a little bit further with the QQQs, but both are coming off of setting recent all-time highs. The FANG index going sideways lately, but still above its 50-day moving average. And here's another look where we're still above this longer-term trend line, but we've not been able to get back above this shorter-term trend line. ARC pretty much going sideways, just about ready and in the process of generating a golden cross here, which we haven't seen one of those in a while. So even though this is a golden cross, we pretty much have been chopping sideways with ARC. Then we use the all world ETF, which excludes stocks from the US, still in an uptrend, but pulling back and actually falling below its 50-day moving average. Then we do a ratio of US stocks versus world stocks, showing how US stocks are still outperforming. Then here's a monthly chart, kind of looking at the same approach. We do a ratio between US stocks and stocks around the globe, showing how US stocks are outperforming and still above an advancing moving average. And the momentum of this ratio is still going higher as well. Keep an eye on bonds, where we've been really coming down with the 7 to 10-year bond ETF, and that means the 7 to 10-year yield has been going up. The total bond ETF is seeing some weakness here, but still in an uptrend. The Pring World Bond Index also in an uptrend, but it really started to go up and now has been really pulling back lately. A monthly chart of stock to bond ratio shows how stocks are outperforming longer term. And this is a daily chart here. When this is going down, that means bonds are underperforming stocks. High yield bonds, which means junk bonds, coming back down to about its 50-day moving average. And this chart anyway, tends to follow the stock market as well. And that's what we're doing right now with the S&P, right about at the 50-day moving average. Investment grade bonds, which are more conservative, taking a little bit more of a hit here, but still in a longer term uptrend. Could come down and potentially test this 200-day moving average. Dow Jones Corporate Bond Index, also in an uptrend, but seeing some recent weakness. Then I have some fib retracement levels here on the 10-year yield, but we're not really close to those levels right now. This is a long-term chart of the 10-year yield, where for a long time we were seeing a series of lower highs and lower lows as interest rates were going down. Now we're possibly shifting back to a higher interest rate environment, and that's what we've been seeing going back into 2022. Some other fib retracement levels with the 30-year yield, but we're not really close to those lines. Then you can see on the daily chart here, where starting in the spring, we were really coming down with the yields. Then we bottomed out, and about the time the Fed started cutting rates, which means rates were going lower, these yields started to go back up, and we've been seeing them really climb ever since then. There's a weekly chart looking internationally with the US and UK rates going up and being the highest. German rates also advanced, and we actually ticked down a little bit recently with the Japanese rate. We want to keep an eye on the volatility of bonds. That's measured by the MOVE index, and as bond prices have been going down, volatility is going up, and the VIX has been very high lately too. And we can see that there's a pretty strong correlation between the volatility of stocks and the volatility of bonds recently. We look at the S&P 500 and compare it to short-term 1 to 3 year Treasury bonds here. We had been up outside of the rainbow, but lately seeing a bit of a pullback. We look at the S&P 1500 and also look at shorter-term bonds, also coming back down slightly into the rainbow. The broad market, a different measure, but a little further out bonds, 3 to 7 years, also coming down a little bit, but all the lines in the rainbow continue to go up. The tech sector with 3 to 7 year bonds also seeing some weakness, not coming back to this previous high, but showing some improvement here, not really falling apart, but not seeing the strength that we were seeing earlier in the year. We do another ratio between riskier bonds, which we know them as junk bonds, and more conservative bonds. And folks are tending to prefer the junk bonds. They're willing to assume more risk to get a higher yield. We look at a correlation between stocks and bonds, and this is bonds based on price, not yield, and they're having a pretty strong tendency to go in the same direction. They're either going up or down together. Then we look at the S&P 500, compare it with the 10-year yield, where stocks have been outperforming, but as rates have been going back up and the S&P has been underperforming a little bit going back to October, we're actually seeing some weakness. We could come down to the 200-day moving average to test this ratio. Then 3 to 7 year bonds compared to stocks. When this is going down, that means bonds are underperforming, or to say it another way, stocks are outperforming. Junk bonds, which are coming down close to their 200-day moving, 50-day moving average. And we do a ratio between junk bonds, the riskier bonds, and then more conservative bonds. And the ratio is starting to turn back up, and we're just getting ready to see a golden cross as folks are preferring the junk bonds. Here's a monthly chart of the price of the 30-year, where we had come back and actually started to go above the longer-term moving average. Now we're dropping back below the moving average. And we also look at a ratio between the long-term bond ETF and commodities, showing how the long-term bond is outperforming. Then we go through a number of different sectors. We have the material sectors, which is looking pretty good all by itself, but it is falling a little bit below its 50-day moving average. But when you compare it to the S&P, materials are underperforming. Communication, really doing well, and the S&P had been doing well. That's why we were seeing this ratio going sideways, but we did see an improvement. And communication, another really big area here that's been looking pretty solid all by itself. Then energy, which is kind of fighting right now. We're just about ready to see a death cross here in this sector. And it's also underperforming the S&P 500 when we look at the ratio. Financials looking pretty solid. Even though they've been going sideways to slightly down, they're still above their 50-day moving average. The financials are still looking pretty solid and actually in an uptrend compared to the S&P. Industrials coming down and testing their 50-day moving average. And on a ratio basis, we've just seen a recent golden cross here when we look at this ratio overall, even though it's been pulling back lately. The tech sector, this is a really important area. We're coming back down and actually hitting the 50-day moving average, but in a downtrend when we compare it to the S&P. Now, earlier on, the tech sector was really outperforming. And then about the middle of July, that's when we hit a high, and we've been underperforming since that time. Staple sector, which are in an uptrend all by themselves, even though they're falling below their 50-day moving average. And we do a ratio of staples to the S&P where we're in an uptrend, but right after we set this uptrend, we've been seeing some weakness with staples. Real estate, which has been under a bit of pressure lately as interest rates have been going back up, falling underneath their 50-day moving average and going sideways when we compare it to the S&P, but we saw enough of an improvement earlier in the year so that we actually have seen a recent golden cross with this ratio. Utilities, which have been really strong, but pulling back and actually coming under their 50-day moving average, and still looking pretty solid here when we do a ratio with the S&P 500. Then we look at another ratio of the S&P to utilities. When this is going up, the S&P is outperforming. When this is going down, the utilities are outperforming. But we've been chopping around quite a bit in the recent past here. Healthcare, which is more defensive, coming down and testing its 200-day moving average. But when we do a ratio, it's really underperforming. We were seeing a bit of an improvement here, but lately it's been really coming back down with this ratio. Discretionary, looking pretty good and actually one of the better areas. For a lot of 2024, this area was really underperforming. Now it's looking a little bit stronger, and Tesla and Amazon are included in this group. And we're seeing an improvement here, enough to possibly generate a golden cross with the discretionary to S&P ratio. Semiconductors actually falling down below their 200-day moving average. Now, we did that before, and we were able to bounce back up. We'll have to see if we can bounce up with the semiconductors and avoid seeing a death cross here in this sector. If we do a ratio of growth stocks versus bonds, showing how growth stocks are outperforming. And then we do another ratio of energy to tech. When this is going down, that means energy is underperforming the tech sector. Then we look at the tech sector versus the 10-year yield, coming down to the 200-day moving average here, but overall still in an uptrend, meaning tech is outperforming the 10-year yield. Here's an inverse of that, showing how the 10-year is underperforming the tech sector, possibly coming up to about this 200-day moving average. And discretionary to staples. In a downtrend, when we look at discretionary, how it's been underperforming, but lately it's been showing some improvement. Tesla came out with their earnings recently, and that's really helped the discretionary sector. And we could be getting ready to see a golden cross here with this ratio. This is an inverse showing how staples had been outperforming, but recently have been underperforming discretionary. Gold to the S&P 500, gold is slightly outperforming right now, and gold is outperforming the dollar. Even though the dollar's been going back up, gold has been doing even better. The NYSE composite coming down to about its 50-day moving average. High leverage loans, not really seeing any real weakness here and still well above its 50-day moving average. All stocks, which looks at U.S. and international stocks, coming a little bit underneath the 50-day moving average. Emerging markets coming down to the 50-day moving average, but still in an overall uptrend. The Japanese Nikkei index really chopping around lately, but still at pretty high levels. Microcaps, smaller stocks, coming down to about their 50-day moving average, but still in an uptrend. And Bitcoin just recently had a golden cross here, and I actually forgot to change that at the end of this video. It should go from the negative side to the positive side. And we want to keep an eye on the home builders. We're not really seeing much of a negative divergence right now, where the correlation between the two is fairly strong. And then this is a long-term oscillator where the Chinese government had come in recently with cutting rates and adding stimulus. That saw this really going up, but now we're seeing money coming out of China. We're also in a longer-term downtrend in emerging markets as well as Europe. Japan is also going down, and we're kind of sideways to slightly down with U.S. stocks. We look at an intermarket analysis chart showing that gold is performing the best, followed by stocks. Then oil and the dollar are about the same, where bonds based on price are still negative year to date. We also look at some correlations between the S&P 500 and the dollar, and they're kind of neutral, but having a slight tendency to go in opposite directions. We also look at a correlation between the S&P and oil. That's pretty much neutral right now. And the S&P to the 10-year yield having a slight tendency to go in opposite directions. So if one is going up, the other one is typically going down and vice versa. Also, the 10-year yield to tech also going in opposite directions right now. And the S&P to the 2-year yield going in opposite directions. The market finally was concerned about interest rates going up, and that's why we've been seeing some pressure with stocks as yields have been going back up. Then some long-term charts. This is a monthly chart of the NYSE composite, seeing a little bit of weakness, but still above an advancing moving average. And the Copic curve, which is a momentum oscillator, continues to go up. This is a daily chart of the NYSE, and then we look at the NYSE record high percent index, coming back a little bit here, but overall we've been really strong with the broader market as measured by the NYSE. A monthly chart of the S&P 500, still above the moving average here, but rolling over a little bit when we look at the percentage price oscillator, another momentum oscillator, and this is longer term, so we want to keep an eye on this one. Then we have the S&P on top and then a ratio between stocks and commodities down below. Earlier, I showed a different version of this chart. Well, this is continuing to go up, meaning stocks are outperforming commodities. Then we look at another global index here and compare it with U.S. stocks, showing how U.S. stocks are outperforming. But for most of 2024, we've been going flat with this momentum oscillator. Then at the end, I list all those things that are positive and those things that are negative. And our list is still pretty long, where we have growth and value by themselves are in uptrends. Copper's in an uptrend. The British pound and euro, even though they've been seeing some weakness, they're still in uptrends. And my definition of an uptrend is when the 50-day moving average is above the 200-day moving average. We're also in an uptrend with the yen compared to the dollar, even after seeing some recent weakness. Gold and silver are in uptrends. The big software companies, mega caps, the FANG index, low volatility stocks, as well as staples, the Dow Jones Composite average, all the bonds that we look at based on price, even though they've been pulling back, they're still in longer term uptrends. The tech sector and semiconductors, and we're in danger of seeing a death cross here with the semiconductors. High leverage loans, which is just suggesting that the economy is still looking good, according to that ETF. The Dow, the NYSE Composite and Wilshire, the NASDAQ and NASDAQ 100, mid caps, small caps, and micro caps, and all stocks, and emerging markets. And Bitcoin should be on this list as well, where I have it over here on the negative side. And that's when the 50-day moving average is below the 200-day moving average. So the CRB index is really choppy lately, but it's still in a downtrend, as is the dollar, even though it's been bouncing back up. ARK is in a downtrend, but possibly seeing a golden cross starting to form there. And Bitcoin, which also has just shown us a recent golden cross. So this should be on the other charts. Thank you. I hope you found this helpful. I hope you have a great weekend, and I will talk to you in the next video.